There is one man who could keep the rally going. It all does depend on what he says in his testimony on Capitol Hill. Today, I'm talking about Fed Chairman Ben Bernanke. For more on the markets, we welcome Paul Hickey, the co-founder of Bespoke Investment Group. So, Paul, we've been talking these past several days about how stimulus was being priced in, and after yesterday, you'd have to say that it is being priced in. What would it take from Bernanke, in your opinion, to keep this rally going?
I mean, just like you said, in the past few days, the expectations have gotten high, so high from it. You know, we had the Wall Street Journal article yesterday, which really got people, boosted on that idea that we're going to get the stimulus.
And then Lockhart and Janet
and then testimony.
Yellen's.
Yeah.
Sure.
So, there's this. The bar has been set in terms of expectations pretty high. So, I mean, you get these situations where, it seems all you can do is disappoint.
Are we at all premature in calling this a rally? It was just a few days ago, all of us were sitting here saying the sky was falling.
You're exactly right. I mean, a two-day rally doesn't necessarily mean the correction's over. It's just amazing how bad sentiment was Monday and now how positive people are getting now. But it just goes to show the headlines. Every day there's a new headline, and every day that's what the market reacts to.
Well, are you nervous about how much we're using the word hope? Hope for central bank action, hope for Spanish bailout, hope for a European solution to the crisis?
Hope that the fiscal cliff gets resolved, hope that the economy rebounds. Yeah, I mean, when you're thinking, when you're banking on hope, that's not the greatest strategy to be taking.
Well, not before long, we're going to get actual anecdotal evidence from the companies themselves when they start to report earnings in July, starting with Alcoa following the 4th of July holiday. What do you expect to see in terms of actual impact from the European debt crisis, all the uncertainty hovering over the macro picture?
I think there's going to certainly be an impact, but more importantly, any company has the greatest excuse in the world now that Europe is a problem. You never hear about companies saying a good economy is boosting their results, but you always hear about a bad economic condition is hurting results. So.
We just showed a chart, actually, that indicated how S&P 500 2012 EPS analyst estimates hasn't really gone anywhere over the past year. Take a look there. Pretty much stuck at $105. If the world was really coming to an end, wouldn't we see much more aggressive action by analysts taking those estimates down? Yeah,
the overall number hasn't seen a big decline, but we've been seeing in the last 4 weeks, we've seen a big pickup in negative revisions on the part of individual companies and the individual analysts who follow the companies. We got positive in net revisions towards the end of earnings season, but ever since earnings season ended, it's gotten really negative. So analysts are pretty negative right now.
Which sectors were most sensitive to those revisions?
I mean, the energy sector has just been killed. I mean, with the oil down and natural gas where it is, I mean, that's somewhat understandable. We've been seeing tech earnings revisions come down. So, I mean, it's been across the board. The only sector that had positive revisions, according to our tracks, as of the last week, was consumer discretionary.
If you look at the 10-year yield, Paul, 1.6%, how do you make sense of that with the action in stocks? Does stocks have to play a catch-up game to what's happening in the bond market?
Well, when you compare the valuations of the equity market versus where bond yields, treasury yields are, you're at a situation where equities are cheap relative to bonds. But the point is the level of interest rates, a natural level of interest rates, and is it sustainable? So, I mean, if we saw an increase, comparing the two at where they are right now, equities are very undervalued. But when you see an increase in rates, it changes that quickly. But the key thing we're thinking about is, we're talking about will Bernanke give us more stimulus to lower rates? If you look back since 2009, every increase in the market has coincided with an uptick in rates. So, I mean, it's not necessarily that is lower rates really what we want here? It hasn't really done much to help things. And, and every time rates go down, it coincides with the market.
I want to go back, if I may, Paul, to the chart that we pulled up, that Scarlett made reference to. And draw a comparison between that and the 10-year yield. A 10-year yield of 1.64, which is exactly where it is. Yeah, this is the chart. So if the 10-year yield is a 1.64, okay, we know that the levers that the Fed is pulling artificially depressing that part of the curve. But surely that suggests an economy far worse, right, than the $105 on S&P 500 earnings would suggest. So what has to happen? Either the 10-year yield goes up or analysts start aggressively taking that number down after the second quarter?
Right. Well, when you see, typically you tend to see the negative revisions start to pick up towards the end of the quarter. We still have almost a month left in the quarter, and then you tend to see the warnings, and then you see the analysts take down estimates. So, I mean, we still have plenty of time for that to happen, unfortunately. But just the fact is that like you said, we haven't seen much decline in the overall number, so that is something to expect going forward. But I don't think it's going to be a surprise to many people either.
So the stock market as a discounting mechanism has already priced that in?
Well, if you look at strategists' allocations towards equities are at the lowest levels since March of 2009. You have the individual investor sentiment is negative, it's the lowest in September. You have one indicator that we look at is headlines on the Drudge Report of financial-related headlines. And when a financial headline makes it onto the Drudge Report, it's not a financial site. So when you see that move over, you tend to see it move into the mainstream. And when they move into the mainstream,
where are strategists saying you should be allocated?
It's in the low 50s right now. And then when you get to that, it's been as high as close to 60. And it's not a huge swing, but it's the lowest that we've seen.
So if that's the case, are stocks low enough at 1315 on the S&P 500?
Well, here's the thing: you have sentiment, which is negative, and you have valuations, which are cheap relative to history, and that's on one side. That's not going to spur a rally in and of itself.
But valuations are cheap on the basis of trailing earnings and forward earnings, which we just decided have yet to be cut.
Right, but so at 105, you're trading at under 13 times earnings. So if you go, even if you get a 10% drop in earnings estimates, you're still cheap relative to history.
There we go. Paul, thank you very much.
Thanks for having me
this morning. Paul Hickey, the co-founder of the Bespoke investment group here in the Inside Track.